While major market indices such as the S&P 500 and the Nasdaq Composite have had a successful year, not all stocks have joined in this upward trend. The significant growth in the market has largely been attributed to the remarkable performance of major tech companies and their substantial increases in stock price. These prominent companies such as Google, Nvidia, and Microsoft have played a pivotal role in driving the S&P 500 and Nasdaq Composite to respective gains of 13% and 26% during this year alone. However, since the market has done so well, largely on the back of some major tech companies, some more traditional blue chip stocks have begun to look relatively cheap. One stock that I think is currently worth looking at for this exact reason, and a company that I have talked about on this channel many times, is the Coca Cola company, ticker KO. So in this video, I'm going to explain why I think this dividend king is sitting at an attractive valuation right now and why it might be a buy for your portfolio. Before we start this video, make sure to like and subscribe if you're new to the channel, because I will be posting dividend stock videos just like this one every few days. It is true that Coca Cola is already valued at a very high level and that there isn't much room to grow as there has been in the past for the beverage company. The company already exists in many sectors, already provides drinks to big businesses' food chains, and already has global market penetration, meaning room to grow has been limited. But on the other side of the same coin, this is exactly what makes the stock very low risk, and its drink portfolio offers investors with a brilliant risk-reward business structure. The company has established itself as a cornerstone of not just drinks, but the economy itself. This is clear because the company has a beta of roughly 0.5, meaning it fluctuates far less than the rest of the market, because no matter what people are doing, they are always going to be drinking Coca-Cola. Due to this, the recent pullback in market valuation makes the company look extra attractive, as events like this are pretty rare for Coca Cola stock. So let's talk about the stock, and speaking of valuation, let's talk about that right now. Coca-Cola has always traded at a premium because buying into it has always been one of the most safe stock market plays. You are buying a premium company and therefore it always trades at a premium price. The stock currently trades at a PE of 23.5, which is actually low for this company despite what you may think. Although it is still higher than the S&P 500 average of 20, most S&P 500 companies aren't as resilient nor established as Coca-Cola is. This current PE value is the lowest it has reached since the COVID-19 pandemic, and since then it has generally traded at a PE ratio between 24 and 28, meaning 23.5 is definitely on the lower end. The company is also closing in on its 52-week low of $54.02, and it is way below its 52-week of $64.99. The second important part of Coca-Cola stock is their outrageously sturdy dividend. Due to Coca-Cola being so stable and a very mature company, a lot of their earnings ends up being distributed to shareholders via their dividend. The Coca-Cola company currently yields 3.23%, which is over double the market average. They have paid and grown this dividend for 62 years, going all the way back to 1961. The dividend growth rate is also surprisingly not too bad, with their most recent bump being equivalent to 5%, which for a company this old is still a good thing. The 10-year growth dividend CAGR for the stock is 5.21%, showing that this growth is very consistent as well. The payout ratio for Coca-Cola is also at 56%, which means there is definitely room for growth still. Warren Buffett is famously a big lover of Coca-Cola's sturdy dividend, and because of the dividend growth over time, Warren Buffett makes back his initial investment into Coke less than every 2 years in just the dividend alone. Buffett also has famously said that he will never sell a share of Coca-Cola, showing his faith in the company's dividend growth capability. Lastly, we should talk about Coca-Cola's pathway to future successes and increased revenue growth. Although I said at the start of this video that Coca-Cola will have a much harder time growing than it has in the past, that doesn't mean it's impossible. Coca-Cola has been continuing to innovate their product portfolio through acquisitions into different drink spaces, and if they keep growing this portfolio, growth should continue as their market space in the beverage world grows as well. Coca-Cola is currently focusing on more healthier alternatives to their sodas. This is because current consumer buying patterns are changing and the younger audience is becoming ever more cautious of what they are putting into their body. This means Coca-Cola is becoming a drinks business rather than a soda one, which it's been doing for quite some time, despite the fact that most consumers do not yet recognize this. That is why in 2021, they finished their complete acquisition of Body Armor sports drink, as they're trying to get more market coverage in the sports and health drink world, in addition to Powerade, bringing the fight to Pepsi's ever-popular Gatorade. In fact, many of Coca-Cola's innovations in the past years and even decades have been related to more healthier drinks. In 2007, they purchased Vitamin Water, in 2011, they purchased Honest Tea, and in 2020, they bought Fairlife Milk outright. Long story short, all of Coca Cola's recent innovative flavors, drinks, and acquisitions have all been an attempt to branch into healthier segments of the beverage business, which started all the way back in 1960 with Coke's major acquisition of Minute Maid. If Coca Cola can continue to grow their brand portfolio and make smart acquisitions into the right part of the drinks business, then revenue growth is sure to follow. The other major way Coca Cola is able to increase revenue growth is through flexing their pricing power. Coca Cola is a major player in the drinks world, and people have become accustomed to their taste and brands, meaning if Coca Cola is to raise prices, most people will still buy their drinks. This is evident by their recent price increases over the past 2 years, which they've done to combat higher costs due to inflation. Not only that though, this has allowed them to drive up revenue by 6.82% in the past year and 6.96% forward revenue growth, despite the fact that sales were largely unchanged. Although this isn't a sustainable business strategy, as if they keep increasing prices, other companies will steal their market space by undercutting them, it does show Coca-Cola's ability to dictate market pricing because of their strong brands and portfolio. Ultimately, Coca-Cola is not a company that will get you rich quick. This is a classic long-term blue chip holding that you should add to portfolios to offset any over-speculative businesses. The company has a great balance sheet and portfolio, and it retains a long dividend history, which is sure to grow over time. This current valuation at just around the $57 mark is very low for recent history and could be a very good entry point if you're looking to open up a new position. For younger investors or for people with many consumer staples already in their portfolio, this may not be a good stock for you, but for tech-heavy portfolios or for people who want more dividend security, this stock is a golden one, and I cannot understate that. Thanks for watching, and I hope you enjoyed this short review. Leave a comment down below about your opinion of this video, and make sure to subscribe to keep up with future episodes. Do you own any Coca-Cola stock yourself? I'd love to know. Thank you, and goodbye.